Hey everyone, my name's Ben Bolger and welcome to the Expat Blueprint, the platform educating expats to financial freedom. Welcome to episode number 12, and it's the last of what I would call the foundation series. So far, we've explained essentially the very broad concepts of financial planning to make you aware of some of the key areas you need to be thinking about. In the upcoming weeks, we'll be starting our How to Invest series, where we'll be breaking down everything you need to know from start to finish on how you can start investing for all the things you want to achieve in life. However, today, we're going to close out the series with an extremely important topic and one that keeps some of you up at night. You might have guessed it, we're talking about a fella called Uncle Sam, also known as the tax man. Often one of the biggest headaches amongst expats is often how their tax liability changes as they move from country to country. Taxation is a huge consideration when wealth building, because not having the right knowledge around your country's taxation rules or not being aware of how assets are taxed globally can massively impact your wealth. I don't think there are many people walking this planet who love paying tax, hence many of you who are listening to this might be in tax-free countries like the UAE. But why do countries tax their population? Well, countries will typically use the proceeds from the taxes they enforce to fund services and provision for the public, such as hospitals, schools, public transportation, infrastructure like roads, communication and energy systems. Now, you can probably appreciate that every country has a separate tax regime, and therefore it would be impossible for me to cover global taxation in a 10-minute podcast. However, today I wanted to provide a good understanding of a few basic types of taxation you are likely to encounter as you work towards financial independence. These types of taxes are likely to be present in some form wherever you are in the world, obviously unless you live in a tax-free country. It is vitally important that I make it clear that when looking at tax planning, you seek qualified advice, as it's such a crucial and intricate subject. I urge people to get professional help for your situation. However, that doesn't mean you become lazy and just pass on the responsibility of taxation to a professional and not gain any knowledge around the subject. Having a grasp of the basic forms of taxation will ensure you're getting the most out of your financial planning and you make good decisions in the future. Today, we're going to go through three of the most common types of taxation you're likely to encounter in your life, which is income tax, capital gains tax, and inheritance tax. We'll solely focus on understanding when each tax is likely to be due and how it affects yourself, your assets, and your beneficiaries. So it's probably best we start with income tax, as this is probably what most of us are most familiar with. What is income tax? It is the tax that we pay on our salaries from our employment or our business, interest from bank accounts, dividends from investments, or any other types of forms of income you might receive in a year. This tax is charged by the government, but also in some countries you might have to pay a state tax or a local tax. You are typically subject to the income tax in the country you're resident in, and will pay tax to the government there. There are some countries like the United States and more recently South Africa where the government requires you to pay tax on your overseas income even as a non-resident. If you're an expat that spends sizable time in different countries, you must understand your residency status, as you could be in a position where you're accidentally eligible for tax in more than one country. If you're British, I would recommend KPMG's statutory residency test flowchart as a user-friendly way to initially assess whether you would still be classified as a UK resident or not. So when does income tax have to be paid? Now, for those of us that live in the Middle East or any other tax-free country, we're very lucky that income tax isn't something that we have to consider. However, for those who aren't living in a tax-free jurisdiction, this taxation is likely to be deducted either at source directly from your salary before you receive it, or collected by a self-assessment tax return form that you will need to submit every tax year. Most developed world countries have their income tax on a progressive taxation basis, whereby the more you earn, the more you are likely to pay in tax. Usually, countries will also have a basic personal allowance, whereby your income up to a certain amount will be taxed at 0%. The earlier amounts of income past this threshold are likely to be taxed at lower percentages, however will escalate as your income increases. There are different types of products or methods for legally reducing the amount of income tax you pay each year. An example of this in the UK would be paying into a pension or an ISA. These are known as tax wrappers and are efficient planning tools available to build your wealth and reduce your tax liability for the year. One area where expats living in tax-free countries might get caught out is where they own income-producing assets such as real estate in other countries that do tax income. This income is normally eligible for taxation in the country it's generated. For example, if I was to own a property where I was earning income above the personal allowance threshold, I could be liable to pay tax on all the income above that threshold, whether I was resident in that country or not. The second type of tax that you need to be aware of is called capital gains tax. What is it? Well, this is a taxation on profits where your assets have increased in value. When investing, you buy assets typically on the basis that their value will increase at some point in the future. I mean, it would be a pretty crap investment if you bought it and then expected the price to fall. You will then at some point decide to crystallize these gains, or in layman's terms, sell your asset and therefore realize a profit. At this point is when a capital gain is made and potentially some form of tax is due. These profits are often taxed by the taxman at a capital gains rate. Typically, capital gains rates are lower than income tax, and therefore are usually attractive to higher rate taxpayers. What I mean by this is that a higher rate taxpayer will usually prefer an investment that is going to generate a gain, so one that it will increase in value, as opposed to one that will provide them with an income, because the income is likely to be charged at a higher rate. Examples of typical gains that expats may face are a sale of a property or a piece of land, a sale of an investment or a stock, or even a business. Just so that I can illustrate the point, I buy an ETF or a stock at $80, and after a year it's now worth $100, and I decide to sell and bank my $20 profits. Capital gains tax is the tax that is applied to the $20 profit and not the whole $100. Again, each year you have an allowance, which is usually in addition to your income tax allowance, where the first portion of your gains for the year does not incur tax. However, once your profits for the year go beyond your personal allowance, these profits are subject to tax. The interesting thing about capital gains, however, is that within a year you may be allowed to utilise any losses you have incurred against the gains that you make, and therefore this will reduce the profit you have in the year that is subject to tax. The final type of tax we're going to discuss today is inheritance tax, also known as estate or death tax. This type of tax, if applicable in your country, is due on the death of an individual and is taxed on pretty much everything that a person owns, which is called their estate. This tax is applied before any assets such as cash, personal belongings, property, businesses, and so on can be passed on to loved ones or any other beneficiaries that would be set out in your will. This tax is usually expected to be paid pretty quickly. For example, in the UK, it should be paid within 6 months of the death. A major difference between income tax and inheritance or death tax is that it's likely to depend on your domicile and not your residency. Working out your domicile can be a complex case, but it's the country you have a substantial connection with, and therefore is likely to be the country you were born in unless you've opted to change it. So that being said, a British expat could live abroad for the rest of their lives and will likely still be British domicile and therefore be eligible for inheritance tax on their worldwide estate when they die. A huge part of tax planning when looking specifically at inheritance or estate planning is to understand and confirm exactly what your domicile is. I again really urge people to seek professional advice here because it really does depend on a huge amount of different factors. Again, like with all other types of tax we've discussed today, there is often an allowance available whereby you have a set limit where your lifetime wealth up until this limit will not be taxed. However, once your lifetime wealth or estate breaches this limit, the value above the threshold is subject to tax. This tax can often be quite hefty. For example, in the UK, an individual currently has £325,000 of nil rate band or an allowance, but then anything above that is taxed to 40%. So imagine a British domiciled expat with an estate worth £1 million. After taking away their allowances of £325,000, £675,000 would be subject to tax. If you apply the 40% tax rate, then the final bill before their beneficiary receives a penny would be £270,000. As you can see, this would be a sizable amount for people who have accrued a lot of lifetime wealth. Now, there are several different rules surrounding inheritance or death tax. With proper financial planning, the amount of tax your loved ones or beneficiaries pay can be drastically reduced. At the end of the day, I'm sure you would want as much of your wealth that you've accrued over your lifetime to be passed down to the people you love as opposed to be heavily taxed by the government. Look, taxation in some form has been around since 3000 BC, starting in ancient Egypt, and therefore isn't something new to the human race. However, taxation can be a very complex issue because as countries and nations develop, governments change the rules to meet the needs of their country. It is therefore vital that you have some understanding of the type of tax that you would be liable for, and also work closely with a qualified tax expert to ensure that you are not paying any more or less tax than is needed. As we get further down this journey and I've delivered a basic understanding of all the needs of financial planning, I will then start to develop more content around some of the more complex areas to help people understand more about taxation and some of the strategies to reduce it. I hope you found today useful. If you did, don't forget to leave a review and share our content. We're on a journey to help as many expats as possible, and we need your help to spread the word. Be the person who introduces your friend to financial freedom. See you all next week, and remember to always dream big.